this panel. It's one of my favorite topics, and I feel like a lot of people are talking about it, but hopefully we have a little bit of a fresh take. So we're going to be talking about bridging TradFi, blockchain, corporate applications, and the role of stablecoins. There's been a lot of talk about stablecoins. Our previous panel touched on it quite a bit, Patrick being at Circle, of course. Before we jump in, I'm going to have our panelists introduce themselves.
Hi everyone, my name is Jess Sevinc. I'm Senior Corporate Counsel to Gemini, overlooking their legal and regulatory matters in UK and Europe. And yeah, excited to be here.
Hi everybody, my name is Madeleine and I head up programs and innovation at Global Digital Finance. We're an industry association, but my colleague Elise was on the panel right before this, so hopefully I don't have to do the intro.
Hi there, I'm Chloe Nightingale and I'm the founder of Night Free Consulting. I help startups mainly from pre-seed to seed grow and scale in this environment.
Hi, I'm Jess, Houlgrave. I'm the CEO at Reown. We're the builders of the Wallet Connect network. So if you've ever gone onto a Web3 app and connected a wallet, you've probably used our infrastructure. And increasingly, we're seeing that happen in TradFi as well. So I'm very excited.
Great. First question is yours, Madeleine. From your role at GDF, you engage across the entire industry. What role are you seeing tokenization play across this space?
So I think from my perspective, tokenization has just been one of those sort of key facilitators in terms of thinking about institutional adoption and how it's scaled really over the past few years. I think for quite a while, we were thinking about crypto and tokenization as not being part and parcel. That's very much changed, I think, in the past few years, thinking about what is the underlying infrastructure that allows for tokenization to really scale. So I know that we'll probably talk about that quite a bit going forward, but it's been sort of a key enabler in getting the buy-in really from large institutions to participate in these markets. And from my perspective, that's done a huge amount of good for the digital asset industry as a whole, and the participation from large financial institutions, cap markets moving into the digital asset space, or moving on chain, has really sort of given a lot of the credibility that broadly the digital asset space sort of needed and how we've navigated the past few years. So I think the role of tokenization has been really, bringing that buy-in, and obviously there are loads of applications that come from it. So, I don't want to go into all of the depth, 2 seconds into the start of the panel, but, I think at the moment there's a lot of interest in collateral management, optimization, mobility from financial institutions is like one of the starting points in how to, in understanding how to really actually derive strong monetization strategies from all things tokenization. So we're doing a lot of work related to that at GDF as well, but that's certainly one of the starting points, I think, where firms are like, okay, this is how we can make use of it.
Great. And to build on that, Johnner, can you take me through how stablecoins are already being used, some real examples?
I think from at least our perspective or exchanges perspective, we see stablecoins are wanted by traders. They brokers want it, traders want it rather than retail. I guess there's maybe a misconception of that, stablecoins can be a remittance tool. That yes, they can, but I guess when you look at the numbers currently, it is more of a trading tool than being a remittance tool or a fixed hedge. So when you look at the markets, there are interesting markets. I'm originally from Turkey. If you look at Turkey market, stablecoins are used as just a fixed tool because people are using stablecoins or exchanges their liras to stablecoins because they don't want to pay. They don't want to go over capital control, and they don't want to pay extra fees to the government because you need to pay 0.5% whenever you exchange. So if you look at niche markets, you can definitely see other applications. Can it be remittance? Can it be invoice payment? Yes. If there's a market that you're using US dollars as a means of payment, but it is hard to access, Swift accounts or USD accounts, yes, people can use it. But I guess more than 90%, I would say that the current use case of stablecoins has been in trading, because traders want, quick settlement. Trader wants, to just access or not have to ramp on, ramp off when they're trading. So they're using that. But it comes with the complexities, both legal and also I think from like auditing perspective. Like, is it easier than holding US dollars or euros to hold stable coins in your treasury? No, it's not. And even when you're like trading, they're just like categorizing those into your treasury and just adhering the right regulatory frameworks. That's been a challenge. That will continue to be a challenge. And that's why I guess we're having these panels, and hopefully we will have less of them, and then we will see a little bit of adoption, not in terms of market, but in terms of regulation and all these like auditors and governments being a little bit friendlier towards that.
Great. Jess, in your role in what you're building, you really bridge and play the point of bringing the tokenization and other people and connecting the industry. What are you seeing, and what are some of the trends from either regions, outflows, et cetera?
So I think that this year has been kind of like the growth year that we've seen. For a very long time, I think people have been talking about stable coins, but the regulatory changes that are perceived to be coming, and the state of the US has definitely been a big driver for real adoption. So we've gone from speaking with a lot of payments companies over the last 12 months to actually building with a lot of payments companies in the last 3 or 4, and a lot more coming online. I think stablecoins is really the biggest driver there. There's still a bit of hesitation to maybe touch some other things. But now we're really seeing people being able to buy at point of sale. We've got a bunch of proof of concepts where you can be able to tap your wallet in the way that you can tap your card to buy at a point of sale. We're seeing the work that Visa and MasterCard are obviously doing around identity and tokenization of assets. Payments companies allowing you to buy with stable coins at the point of an e-commerce transaction. And we're really seeing that start to kind of pick up and get a lot of adoption. In terms of different geographic use cases, I always think that the countries with a less developed financial infrastructure have a kind of a nice advantage here, because they've got a white piece of paper that they can build against. And actually, I think what we're seeing there is a lot of activity in Africa. Nigeria is one of our biggest countries in terms of activity, aside from Southeast Asia, where we see a lot of growth in transaction volumes. And so Latin America and Africa, Southeast Asia, I think are definitely the biggest use cases that are outside of just the pure kind of trading use cases for stablecoins, but where we're actually seeing that in like real world adoption.
Great. And Chloe, can you take me through an example based on your role in what you're seeing outside of traditional financial tokenization? What are some other use cases that you're seeing?
Yeah. It's kind of echoing your point, or following on from your point, really. I'm working with a company at the moment called Agridex. They're based out of South Africa. They're an agricultural marketplace using stablecoins as a payment rail, and using Solana and building on different chains for trade finance. So, those kind of corporate applications and are coming out of South Africa for the trade and finance tools, such as a credit line, insurance interest, insurance payments for insurance, and all of those kind of different applications in trade finance. I think those pieces now building on Solana and coming out of Africa have really, really helped develop that country. And also I think that the people that are in South Africa never had the ability to, for example, like the farmers, so they never had the ability to have an invoice paid. I think it was 121 days was the average, and now it's almost instantly. So they're using USDT. So I think the fees are like 0.2%. whereas on traditional rails it's almost 1%. So all the transaction costs are much less. Likewise with Tether, similar percentage cost there. And I think being able to have the whole supply chain transparency, like on chain for agriculture. I mean, food's not going away. Everybody needs food. Everybody wants food quicker. So kind of building out of South Africa has been a big real world use case.
Amazing. Thank you. You just touched on something. Obviously, I'm from the US and we have regulation in play around stable coins, but stable coins, at least a few years ago, there was this trend where you would call something a stable coin, people would perceive it was stable, and then possibly it wasn't. So what are some of the misconceptions that you view around stable coins? Have those evolved in the recent years? And what are kind of the leading indicators of where you think it's going in the next 12 to 24 months, given the mass, I would say, adoption across TradFi as well as the crypto native industry as well? Sorry.
So I think that clarity around like what we call things in this industry has always been an issue. It's not limited to just stable coins. We love an acronym or a word that doesn't quite mean what it actually represents. And stable coins is no different. And I think regulation and regulatory clarity there is really important. So what can be called a stable coin, what we might have called an algorithmic stable coin probably needs to be labeled very specifically as an algorithmic stable coin rather than just as a stable coin. But I actually think that problem will probably go away over the relatively sort of like near to medium term, because I think for the average user, when they use this as technology, they're probably not even going to think about the fact that it is on crypto rails. So when I think about the British pound today, that comes in various different forms. I can have that in hard notes, M0 money supply. The British pound that I see in my bank account is not that type of money. That's e-money, but we don't differentiate between e-money and British, hard cash or anything like this. And I think for most consumers, when they're going to be using these rails to make payments to one another, they're going to see USD. They're probably not even going to see USDC anymore, or USDG, or HRIJ, or the others, because that also just adds this horrible user complexity. Whereas if I have an asset in my wallet that is equivalent to $1, irrespective of the chain that it's on or who issued that, I want that to be fairly interoperable. And I think that a lot of that complexity we're going to see hidden behind the scenes for people, so that for the average new user who's using this for, again, not in the crypto trading world, that will still need to be described differently, but for the average user who will see a balance in an app probably and be using that to make payments either in store or online or sending money peer to peer, they will just see that it's a USD balance. They won't see the chain and who issued it and everything else underneath. And so they won't need to understand the word stable coin in the way that most consumers don't understand how e-money works. And I think that it won't be long before we're there.
Yeah, and I'm happy to piggyback on that. I think when we're thinking about misconceptions generally in the industry, I think stable coins, have suffered like the tail end of being more on the crypto side. There's obviously the Libra legacy there that, was very closely associated with that. And frankly, I think there was a lot of regulatory skepticism towards stable coins as a general idea in the past, I'd say like 4 to 5 years. And that has definitely faded away. And I think, to your point, a lot of that is regulatory clarity and certainty around like taxonomy and what we actually mean when we're speaking about stable coins. How they're backed, like what are the assets that are being used to back them, how those assets are, safeguarded, custodied, all of those things, whether or not they can maintain a peg. And I think all of that is being fleshed out at the moment. And one of the key indicators to me as to that really sort of being in full motion is that I don't spend a huge amount of time reading all of the regulatory consultations like Elise does, but very certain of the fact that, we're thinking about Japan and like the Hong Kong work that's taking place at the moment, that stable coins are sort of being discussed as key infrastructure components in financial markets as a whole. And I think when we have those signals from regulators, notwithstanding, of course, what's going on in the US, where stable coins are the key top priority agenda under the new administration, I think that certainty is going to enable, frankly, larger use cases to the point that I made earlier in terms of TradFi participation, I mean, we're now seeing major banks try and issue stable coins. Obviously, SocGen Forge led the charge here in the EU a couple of years ago, but Standard Chartered just filed for a Hong Kong dollar backed stable coin with the HKMA a few weeks ago. And I think those are all signals, again, of like TradFi moving into this, which would not happen if there wasn't the regulatory clarity that allowed them to do that. And I think that's sort of one of the big telling points.
Yeah, make it like very quickly. What I can add there is like regulation is also picking up. So now in the UK, when you're offering stable coins, you have to say this is stable coin, and the price may depeg if the issuer fails or issuer's reserves are less than indicated. That is same coming for the MiCA as well. I guess question when you're getting Turkish lira, is it saying that's like, you know, this can fail if Turkish government fails? So we're not treating them in the same way, obviously, but I guess regulation is picking up together with the education. So both exchanges or anyone offering them, now they're obliged to tell the risks to the customers. And I guess, and on the other hand, customers are now understanding stablecoins way better than a couple of years ago.
Great. Chloe, a question for you to kick off, and then the rest of the panel can jump in. What are some of the considerations when a company is looking to enter the digital asset space now, if they build a crypto wallet, or what are you seeing? Are they crypto only, or are they bringing stablecoins as part of their traditional offering?
Yeah, so I think, as I said, I mentioned about the Agridex guys, and coming out of South Africa, I mean, they only are using stablecoins, sure. I mean, I think the biggest thing is then choosing, I think at that beginning, the biggest thing is choosing what chain to build on. I think that is one of the biggest things. There are so many different options there. There are so many different layer one chains to build on. And there are so many different versions of the same thing out there. I think from my perspective, people then come with different use cases and different promises, and some chains have different promises to what they can and can't build. So I often find myself in a difficult situation of then being the intermediary here of this is what I want to build, this is how I want to build it, and then everybody promises the sun and then actually doesn't do it. So I think that is probably one of the biggest considerations there. And then just really mainly about some education around then also which wallet provider and then which stablecoin. I mean, they all have different use cases. And they all have different purposes. So I suppose there's so many options out there. It's quite difficult for companies to correctly choose which one to build on. So yeah.
Really think? I think for most businesses who have an established business, i.e. they're not launching as crypto native, their biggest concern is like, how do I do this in a way that still keeps my customers safe and helps them to start to use crypto in a way that they maybe haven't been able to before? Because I think both businesses and consumers are often a little bit terrified by crypto because of what they see in the news, what they hear, but also actually the statistics around people's experiences when they're using crypto. We still see today 20% of people report every year that they lose crypto because they lose their seed phrase or they're scammed or something else. So these issues are real. They're not just perceived. And as a business that has an existing operation, you want to be very careful about how you enter this space. And so doing it by choosing the right partners, as Chloe says, but also thinking about the flexibility that you can have when you build in this space is really important, because it's not a one size fits all. Who you access, who you give your customers, which applications you let your customers even interact with can be controlled and can be fine-tuned. And so as a business, you have to sort of understand the spectrum of what's possible and then pick based on your risk appetite and the risk appetite you want to pass on to your customers what the appropriate infrastructure and setup is. And I think that's probably one of the biggest challenges is like, where along that spectrum do we place ourselves now? Where do we want to be in the future? And how do we take our customers on this journey in a very like safe and secure way that doesn't damage our existing business and reputation?
I totally agree with that. I think, I mean, to me, it comes back down to sort of management consulting 101, thinking about product strategy, product market fit, what your actual value proposition is. And I think particularly, I mean, when we're thinking about at the beginning, the first question in terms of, what was the tokenization hype essentially let's say a couple of years ago or so, everybody was, a lot of the big banks were like, what are we going to do in this space? What are we going to tokenize? Can I do this X, Y, Z? And it's just, well, it's actually taking a step back from that and working out what you actually want to do with it and where it is in your value chain, for example, that you want to be able to, enhance or move trapped capital as an example, if we're thinking like the collateral mobility use case, and working out really what we're trying to solve for as opposed to trying to just blanket it across the entire value chain, because then it brings you down to, I think, a lot more of the nitty gritty that Jess was going into, which is then, okay, like what's my risk appetite across X vertical? So it's really taking a step back and really understanding, like, particularly as an established firm that doesn't have a digital asset strategy or business line, if they're entering that or in that sort of initial development phase, what are we actually trying to solve for? What is customer appetite around that? Because whether it's customers, retail, buy side, those are frankly, that's where the demand is and that's how you make money off of it. And so it's working that out. It's what is the monetization strategy for it?
On that, John, I'd love for you to give us a summary of the legal challenges that you have seen or you believe corporations face as they want to come into blockchain and stable coins. It's a obviously different world, especially from TradFi, which was your background. So can you take us through that?
I think, I'm just going to maybe like circle back to what I said in the beginning that do they want it? I think they want it. If they want to trade crypto, stablecoins are probably like the best bet that TradFi or not crypto native firms to start their trade. But it of course comes with the like legal and regulatory challenges, and both for exchanges to give them right stablecoins and offer secure, reliable service, because when institutional comes to the trading world, they come with big volumes. Then you're having a bigger risk that you want to hedge. So that's why I think they need to choose very carefully how secure they're going into this space, who they're dealing with, who's their counterparty, and what is the counterparty's background. That's why I think it's very important to make sure that they can. There are like exchanges and counterparties that are secure. They can comply with DORA. They can comply with Europe regulations here in the UK, US, everywhere, and they can be on par with the traditional finance world. I think that's the biggest challenge, because nobody wants a counterparty risk, and it is up to us to get to the level that institutional can comfortably come in. I also mentioned problems of audits. If you're dealing with stablecoins instead of dollars, let's say, your audit becomes much more expensive. It's a challenge to finalize those. Even finding an auditor can be a challenge. I know that in Europe, in UK, in US, people are getting double quoted or not even finding auditors when they say that they're exposed to crypto. I think these are the two big challenges that I see. I think on the counterparty side, I can say that like Gemini, there are big 10-year-old firms right now or exchanges that can reduce that significantly. But on the audit side, it's not my expertise, but I can just hope that it will get better by time.
I think there are a couple auditors in the audience. I just saw move. So if anyone has questions, David can help. There's a trend that I see, and maybe it's because I've been in this space too long and I get a little recency bias. In 2017, 2018, there was a lot of, everyone was issuing their own token. And it was mass tokens everywhere. I have a lot sitting in a wallet somewhere that don't have any use now. There's this issuance of stable coins across quite a few companies. Fidelity just announced they were going to do theirs. PayPal uses theirs. Obviously, they're using theirs for mostly back-end settlement globally. But what are your thoughts on this trend, issuing your own stable coin versus using an already established stable coin with liquidity on chain that's proven and adopted globally with regulatory compliance in place? What are your thoughts on the panel as far as, is it going to be mass issuance of stable coins, or is it going to be a consolidation in the next 12 to 24?
I'll say something, and I'm not sure if I'm going to directly answer the question, but I'll try. So I know I keep coming back to the South African thing, but as you can see, I'm completely obsessed with it at the moment. And going back to that region, they are very skeptical of using stable coins or the word crypto or anything to do with anything we're saying here in general. So we approached the Kenyan authority to talk about them issuing their own stable coin. And they were really, really interested in that because, quite frankly, it came down to the fact that they were not really trusting the current stablecoin model because they just don't know enough about it. So it's not that it doesn't work. Obviously, we know it works, but the USDT is very, very big out there. And but we predominantly use USDC, and we floated the idea of perhaps issuing their own stablecoin, and they were all over it. And I think it boils down to an element of control, perhaps, and a little bit more understanding, and kind of it's then within their reach, and kind of not in somebody else's kind of a pool almost within Circle and Tether. Even though they're using it, they still don't trust it. So kind of building their own stable coin that they can manage went down a little bit better.
So on that, is the government issuing a stable coin?
Yeah, that's what they're looking to do.
Okay.
Yeah.
I think from my perspective, I spend a lot of time thinking about what the landscape for just our space generally looks like in the next 3 to 5 years. Do a lot of work on custody, so thinking about what the digital asset custody looks like in terms of, you know, the tech native players and the engagement, the partnerships that they have with large financial institutions, whether that's a sort of scenario of consolidation, convergence, or, you know, even a risk of disintermediation for some big banks if they're not, you know, looking to enter the space or actively collaborate with digital asset or digitally native counterparts. I think on the stablecoin landscape, from my perspective, just thinking about the past 3 months, like there's a really interesting interplay, I think, across different jurisdictions since we've had the big signals come from the US. So thinking about the fact that, CBDCs are not a question under this current administration, or at least not at the moment. And that's both, you know, as far as I can tell, both on the retail and wholesale side. That, to my mind, that can only push huge innovation in private sector and private money. So looking at, it goes as no surprise then that Fidelity is looking to, issue their own stable coin. And I think there's been a huge push towards that kind of innovation. And I always kind of say that capital markets run like capital markets run, whether it's TradFi or digital assets, and competition does as well. And I think that if you have that kind of push towards private sector innovation coming from one of the largest players in the world, that there's a likely ripple effect looking at other jurisdictions. I also think that a lot of jurisdictions are considering, non-USD backed stable coins, thinking about, dollar hegemony, what that means in global markets at the moment. And to your question, Michelle, I think there's still a lot that's very attractive in exploring alternatives to what already exists, and how those find their way into sort of more systemic infrastructure is yet to be seen, I think. And so I think I can't imagine that won't continue. Like there will be more stablecoin issuances in the next certainly year, 2 years. What that looks like further down the line is it's more integrated into real financial market infrastructure. There may be a little bit of a winner takes all scenario in some markets. I don't know, but I would expect it certainly to continue for a while.
I mean, my take on that, Michelle, is that we've created, and we're in the process of creating, a complete monster here from a consumer perspective. Horrific. It's bad enough that most people need to know what chain their asset is on, and they need some other token to have native gas to be able to do anything with that asset. To then say, oh, actually, like, this isn't the same as this other USD because it's got a different letter on it, so you can use that one at this shop and this one at this thing, like, is horrible if we're honest about it. And so we have to ask ourselves why we're doing that. And we're doing that because at the moment, there is no legitimate and very easy and compliant way for people to share in the economic benefits of being the issuer. And that's what causes this issue. Because if there was a way that said we can distribute those benefits based on where the stablecoin sits or who the issuer is very easily, then we wouldn't have this, because everybody would just say, I will participate and I'll get the benefit of bringing the customers that I bring without needing to go and cut a deal with the issuer. If we can do that automatically, which technologically we can, here all we're addressing is that there is a regulatory battle, and that's what we need to solve in order to make this a very seamless and easy experience. Will it happen? Probably not, because the powers that be don't want that to happen because they're the ones benefiting from it. But actually, like, that's the question that we have to ask ourselves as an industry. It's like, do we need to make this more complex than it already is? And I think if we continue to go down this path of many, many different stable coins, all that will happen is we'll end up creating another layer in between where somebody is doing that simplification, and meaning that the end consumer doesn't really need to know. But what does that do? That adds an additional rent extraction on the end consumer because somebody's got to pay for that. And it's not going to be the stablecoin issuer. So I think we have to have a serious word with ourselves as an industry about whether we want that to be the future or whether we want to try and solve this in a much more elegant and easy way that actually benefits end consumers, which is, I think, probably what drives most people to want to build this stuff.
Yeah, just to very quickly echo on this point, I think there will definitely be a risk conciliation, but it's a question of where. So this could happen in the issuer side. Yeah, a couple of them then can win the fight and others fail. Possible. On the trading side, for example, I think we're already seeing consolidation. So do you definitely need USD order book and GUSD order book, for example, for Gemini's case, where we offer GUSD? Do you need it? I guess not. I think these are the questions that we need to ask. And there is a third possibility that it can happen on the treasury side, but it comes with the regulatory challenges that we need to tackle at least. Then we may have to have a couple of these panels, I guess.
So we've got a handful of minutes left. One last question, and then I'll ask one to the audience because I like to have you all participate. We've talked a lot about financial tokenization. What are other projects that are building real world assets and not just currency and tokenizing them? What are some really interesting projects that either you're seeing, you're engaging, that you're following? What are some of those? Because I feel like we can talk about money, and we've been talking about money, but tokenization is going beyond currency.
I have a cool one, if I can take that. Crypto autos. Has anybody heard of crypto autos before? No? Good. Well, not good. Not good for them, I suppose, actually. They are the auto trader of crypto. So they're crypto auto traders. So they're doing a marketplace for cars. So you can buy a car, essentially, with crypto. So you can go on and look at these high value cars, or maybe a Fiat Panda, I don't know, whatever takes your fancy. And you can upload your Phantom wallet and technically start having a little look at what company will accept your crypto to buy a car, which I think is pretty damn cool.
I mean, I think the most obvious ones to start thinking about tokenization for are ones where there are very established custody solutions. So the process of taking an equity today or a bond, for example, and putting that on the blockchain is a very different process to doing something like diamonds or other solutions, which we've continuously heard about, probably from Diamond Coin in 2017 or something, where people try to tokenize these real world assets, but that have no existing infrastructure around them. Because really what you're talking about when you have a real world asset is that you need some way of enforcing the ownership of that. And if there isn't an established registry, a land registry, or an established kind of custodian solution, then there's an awful lot of infrastructure that needs to be built out in order to make that scalable. We also have to think about whether these things are actually fungible or not, and whether there is liquidity and sufficient liquidity that you can create a market for it. So I think that most likely we will see the tokenization of existing financialized assets first. I think the promise of like the financialization of all assets and putting everything on the blockchain is still quite a long way away because of just this work. Does it make it easier? And I think it is a big question. And I do think that we're seeing a shift, not just driven by crypto, but that is a societal shift in which people want more control. They want exposure to different assets. They're frustrated that they've only been able to buy certain assets for a very long period of time. And so maybe this is part of a bigger shift where people have better access to different asset classes, and that will drive more demand for some of these more unusual things. But I think most likely for the coming years, we'll probably just see the replacement of the back end, call it, for trading existing financialized assets.
So it wasn't the example that I was going to give, but I will piggyback on a few of your points, which I completely agree with. Again, I think real estate, to everything that you've said, is probably a really interesting starting point for many reasons. One, in terms of custody, the legal certainty or structures behind that are much easier to manage because, one, they're so well understood in real estate markets, are highly regulated already. Secondly, because you have the assurance that the house is not moving. It's one of the things that like we're struggling a lot with in the money market fund work that we're doing is depending on the model that you use to tokenize a money market fund, it's trying to understand what the legal certainty for the ownership record behind that is. If you have a digital twin, who is custodying it, and if the money market fund is being used as collateral to move, essentially, where is it? And therefore, does the custodian, if it's sort of based out of the UK, for example, does that custody is it still valid? Do they still have control outside of the UK? Those are all horribly challenging questions, or challenging for me because I'm not a lawyer and I don't know, to be honest. But with real estate, you have the assurance that, it's brick and mortar, it's not moving, and that makes a lot of the baseline, I think, much more, there's a lower barrier to entry. Second of all, I think when we're just thinking about, market dynamics at the movement, you look at real estate, the prices, etc., generations who are buying houses much later than, we've ever seen before, fractionalization of property, etc. There are all really interesting value propositions there that I think will make real estate an application to pay attention to outside of all things financial markets. The one I was going to make, my very small example, if I may, is on tokenization of carbon credits. We've done quite a bit of work on that as well. I think looking at voluntary carbon markets and a lot of the integrity challenges that we've seen to date in those markets, there's a lot of value that tokenization or tokenizing carbon credits could bring to that in terms of solving for transparency, accountability, and so on. And I think that increasingly we'll start to see some of the big standards and rating agencies look to integrate digital technologies as part of the sort of approval process for carbon credits going into the market. So that's one to pay attention to for me.
I guess that was, summarized so well that I don't have anything to add.
Perfect. Okay. We have 2 minutes and then we'll break for lunch, which I know everyone's excited about. Before we end, I'd love in the audience, who has stable coins now? Just raise your hand. Interesting. Who holds crypto? Okay. Oh, well, I guess, yeah. I'm raising my hand for both. I think it's interesting if you look at it, because those who are holding stablecoin was probably about 70 to 75%. It wasn't that way last year. So it is following the trend of what we're seeing and what we're doing, that it is a sidecar to your crypto wall and exchanges. So in our last, what is a takeaway, and where can folks reach you if they want to talk to you more?
You can reach me on Twitter at Jess Houlgrave, or at Reown, or at Wallet Connect probably is the easiest, or find me on LinkedIn as well.
I'm a LinkedIn gal. You will not find me on Telegram because there's too much going on. So I've kind of given up on it. So LinkedIn, full name.
Same.
Yeah, I'm a LinkedIn boy as well. So like, yeah, I'm sorry if I missed any messages from anyone in this crowd via Telegram. I look at every 2 weeks or so.
I think I look at it every 4 months.